Hi, I'm Michael Yardney, and let me ask you a question. Would you lend yourself money? Have you ever wondered what the banks look for when processing a loan application? You probably should if you're planning to apply for a mortgage, whether it's for your home or for an investment. It's best to understand what the lender's criteria are. That, I guess, will improve your chances of getting the loan you want. The banks each have got different models, but basically they all look at what's known in the finance world as the 4 C's of credit: character, collateral, capacity and capital. So let's look a bit closer at what each of these 4 C's represent and see how they could impact on the bank's verdict on approving your loan application. Number 1, character. When the banks refer to character, they're not talking about whether you happen to be a nice, caring person who volunteers time for charity or the like. Essentially, they want to know if you take your financial commitment seriously. They want to know if you can repay your loans. And they do this by looking at your credit history. They ask questions like, well, how stable is your employment? How stable are your living arrangements? How long have you lived at the same place? What type of loans have you had in the past? What have been approved? Did you pay them? Did you miss payments? Do you have a history of paying bills on time? Or are you consistently defaulting, playing catch up on your loans? They're also, I guess, looking to see how your financial facility is in order, and are there any judgments against you regarding bad debts, or maybe you've even been declared bankrupt in the past. They also look at how many credit inquiries you've had over the last little time frame. You see, many of these factors go towards determining your character, as they call it, when assessing your credit file. Now, your credit file is something you should know about. Everyone who's ever applied for a loan, any type of finance, be it a credit card, a mobile phone account, personal loan, home loan, investment loan, of course, has a credit file registered against their name. So whenever you apply for a loan, the credit assessor will obtain your credit file to determine whether you've got good or bad credit rating. They look at your history. This tells them a little bit about your lending character. Lenders want to know you've got the capacity to pay them back and how well you honour your loan commitments. Do you pay your debts on time? Do you pay your debts in full? I guess basically they want to make sure they're going to get their money back. Now, the good news, you can also find out about your credit file. Just go to mycreditfile.com.au, mycreditfile.com.au, and get your credit file. The second C is collateral. What are you offering the lender in security for your loan? For investors or home buyers, this is obviously some type of property. Now, obviously lenders favour certain types of property over others when it comes to assessing a loan application. Is the collateral you're offering a 15 square metre bed sitter, or is it a 4-bedroom mansion in a blue chip suburb? Specialised properties like student accommodation, serviced apartments, really small 1-bedroom apartments, holiday accommodation, sometimes are not considered preferred security by the banks, meaning they may limit how much they're going to lend you in your loan, or if you do get one at all. They may only be able to give you maximum loan to value ratio for better properties, and only 60–70% for these secondary properties. And sometimes they reduce the term of the loan as well. So as an investor, it's critical to be aware of the particular sort of assessment criteria the banks have got, what sort of properties they like, so that you can make your application as attractive as possible. Another factor, of course, is location. A property in a blue chip suburb, in one of our main metropolitan capital cities, is clearly far more attractive to a lender than in regional Australia, rural Australia, or definitely in mining towns. It boils down to this: the bank's concerned, how easy would it be to sell your property and recoup their money should you default on their loan and everything goes pear-shaped? The third C is capacity. What's your capacity to repay their loan? What's your serviceability? When the bank looks at this, they look at your employment income. You could be a PAYG or you could be self-employed. They also look at your rental income and they look at your assets and liabilities. Now, interesting when it comes to assessing your criteria, banks vary considerably. Some are much more investor-friendly than others. Now, if you're an employee, in general, the banks all assess your salary income in the same way. They look at how much you're coming in each month. Of course, they also deduct what you're spending each month, general living expenses, things like grocery, rents, mortgages, utilities. They look at your personal loans. They also look at your credit cards. Now, if you're a self-employed person or a contractor, different banks assess your income very differently. They also assess rental income differently. Some banks are much more investor-friendly than others. Their policies vary. A handful of lenders may be willing to take into account 100% of your property investment rental income when considering your serviceability, but many banks will limit the amount of rental income that goes towards their assessment of how much you can service the loan, often 75%, sometimes even a bit less than that. Now, the reason some lenders look less favourably on rental income than others is they somehow don't see it as stable income. They factor in variables like fluctuations in rentals, vacancy period, property management fees, insurance costs, and things like repairs and maintenance. Now, this may not seem significant to you initially, but think about it this way. If you've got a property portfolio generating a rental income of $100,000 a year, and one bank uses the entire $100,000 to assess your serviceability of the loan, and another bank only accepts $75,000, that means the gap between your borrowing capacity could be, I don't know, maybe $350,000, $400,000 difference. Essentially, this could be the difference between one bank lending you enough to buy another investment property by looking at your rental income more generously. So it's important to understand that different banks have different criteria on how they assess you. And the fourth thing they look at, the fourth C I guess we're talking about, is your capital, your deposit. Some people would call it your hurt money. How much you're putting in, the bigger the deposit, the lower your loan to value ratio. If you're seeking an 80% loan to value ratio, in other words putting in a 20% deposit, credit is relatively easy to come by. However, if you're aiming for higher than that, you often have to go through more hurdles because they send this off to a mortgage insurer. In summary, it's essential to get all your ducks in a row, ensuring you present the lender with an application that he won't reject based on their specific criteria. By doing this, you've got a far better chance of securing that loan that you need to get your next home or your next investment property, and that'll help you reach your property investment goals. It's actually quite hard to do going directly to the banks. That's why at Metropole we have a team of proficient finance strategists that we refer our clients to. They're not part of the Metropole team, but they're affiliates, associates that we deal with in every state to help you work through the maze. You know, some banks currently are very investor friendly and others are a little bit more cautious. So if you want to grow your property portfolio, if you want to take it to the next level, why not have a chat with an independent, unbiased team at Metropole? Call us on 1300 20 30 30 or go to metropole.com.au and fill in the form, and we'll get back in contact with you. We'll assess your current portfolio and make some suggestions, or if you're just beginning, we'd be happy to point you in the right direction and stop you making the common mistakes investors make.